Welcome to this week's live ASX strategy session. Thanks for joining me for another week. Heaps of interesting things to go through today with a lot of movement in the stock market and then also some very interesting things happening in the commodity markets. And we're also going to go through any stock codes you've got and you want to have a look at. So get those ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. Well, it's done something very important this week. So too has the Small Ordinaries Companies Index. I'll talk more about this in a minute. And then over in the US, the S&P 500 has made a new all-time high. But something unusual has also happened. I'll tell you what I mean by that in a moment. But before we do that, let's start with this latest price action in the ASX 200. So last week we spoke about this classic V-shape structure. So the ASX 200 had about a 10.5% decline over 14 trading days. And then that's been followed by about a 9.5% rally over just 13 trading days. So these are typically panic-driven patterns. When you see these V-shaped patterns, it usually involves panic of some type. And there's panic to sellers, people fear the worst, and then it's followed by a rush to get back in once the initial fears become just a little bit less scary. And what makes a V-shaped pattern so difficult is that they often happen so quickly. Like you just see how quickly the whole thing can start to unravel. And that causes a lot of emotional strain. And people often find themselves, getting out of the market down near the lows and then on the sidelines as prices start to rebound. So they can be really frustrating times. And this is why I spend so much time talking about following a plan and not simply reacting to the headlines. As it stands, I think we've had a volatile pullback in the ASX 200 and not the start of a longer lasting bearish phase. We've been discussing that for several weeks. Now, the ASX 200, it's done something important this week, and that is And I think this is the key to the sustainability of this V-shaped reversal. So what the ASX 200 has done, it's held on. It's held on to most of its gains. So this suggests to me that there's been strong buying interest, and that this is more than just a few days of short covering. It's when a market rallies and then quickly gives back its gains. That's when I get most concerned, because that's a sign that the rally's being sold. And at this point, well, you can see that's just not happening here, at least not as things are on Friday at around 1 p.m. Now, the other key point is that prices are now back above these moving averages. We've got the 50 and the 100-day moving averages on this chart. And as we can see, prices are back above the averages. So that disengages that downward momentum that caused so much trouble just a few weeks ago. And it gives the market now a chance to establish support at these new higher levels. What I'm watching now is to see if prices can become re-established above these moving averages. And if they can do that, well, then that would then indicate that buying of the dip is happening, and it's happening on an ongoing basis. But does this mean we should expect new all-time highs in the near term? Is the ASX 200 likely just to shoot higher next week? And this is interesting because, I think what a lot of people is that markets just don't go down, and they just don't go up. They also spend lots of time in ranges, and that's where they just track sideways for sometimes months on end. And I think a range is a strong possibility here. So if we can just sketch this out on the chart, and you can see that the ASX 200, it's essentially been in a big range since, you could say, from late August, or maybe from late October. It's just been traveling in this big range. So yes, it's been volatile. like there's some, these downward moves, of course. So it's been volatile, and but it's all within a range. I think we could see this range persist for possibly several more months. I'll show you why I think that could be. So I'm going to change over now to the ASX 200 equal weight. So the equal weight version of the ASX 200 index. And when we look at this, when we look at the equal weight, it's still about, like, you look at the all-time high, look where we are now, it's still about 9% below the all-time high. It's also still below these declining moving averages. So the red one being the 50-day, the blue being the 100, well, slightly above the 50-day, but it's still below the 100. So we'll say it's broadly below those moving averages still, and the averages are also on decline. So while I like the strength of this rebound, like look at this rebound off the lows, that's a strong rebound. So I like the strength of that rebound. But all the same, the equal weight, it doesn't look poised for new highs at this stage. I think it's going to take time to get from where we are now to the all-time high and beyond. So it doesn't seem poised for those new all-time highs just yet. I think it needs more time to repair the damage from the March correction. And when we look at the materials index, so this is the ASX 200 materials index. This is where the big miners are all contained. I get the same impression by looking at this price structure here. So we've got the quick recovery off the low, so that's positive, and it indicates strong buying, and I think it makes a longer lasting decline less likely. So that's a tick. But when prices quickly rally from below the moving averages, so you can see the moving averages in here, prices got stretched below. So when prices rally quickly from below the moving averages to above, they often pause and then pull back to consolidate. And I think there's a good chance we see that with the materials index. We do see this index come back towards the averages and spend some time. And so if materials pause, then that removes a key near-term driver for the ASX 200. So just coming back to the ASX 200. So let me just take that range off for now. As I was saying, I think there's a good chance that the ASX 200 just remains range bound for a bit longer yet. Neither the equal weight or the materials index, neither really look like they're ready to head to new highs. And this probably caps the ASX 200 for now. So that's not saying it's about to go back into another decline, but just moving within a range. That said, I'm maintaining bullish positioning, and I'm also considering new entries when I see the right setups. So while the index may take longer, I think this is an environment. Now this is all stabilized and prices above the moving averages, I think this is an environment where the right stocks can still perform. We have a market that has sold off twice in the last 6 months. So we had the sell-off in around November, and then the most recent sell-off. So 2 sell-offs in the last 6 months, and notable sell-offs too that caused plenty of fear. Yet on both occasions, there's been a snapback with strong rallies. So when I look at that, that's a sign to me that the buyers are still in control. And of course, I'm coupling any new entries with a calculated exit strategy. That's what I do with the Motion Trader service. We've got those calculated exits so we can control risk. And if a stock doesn't perform, I'll take a small early loss and protect capital. So it's not about getting everything right. It's about positioning to win. As I say, I'm positioned long stock, so it's positioned to win, but at the same time preparing to manage risk in the event that prices do turn lower. Anything is always possible, but I do think we have that more positive tone coming back towards the market. Okay, so we're going to go over to the US market now. Then we've got the local small caps, the US small caps, we've got the commodities, your stock codes. So S&P 500 next though. But before we do that, if you're getting some value, please click that like button. Click the like button, leave a comment, tell me what you think. Do you think we're heading to all-time highs, or do you think this is all just a big fake out and we're heading back to new lows? So what do you think? Let me know in the comments, and please click that like button. It helps me so much because YouTube shows other people. It makes a big difference. So do that now whilst you're thinking about it. All right, S&P 500. Well, here we are, S&P 500, and we have a new all-time high. Now, this was probably the most unimaginable event possible just 2.5 weeks ago when prices were down on their low. They were in a precarious position. They were below declining moving averages, and the news flow was horrible. Yet 2.5 weeks later, here we are at an all-time high. And is so often the case when people reach maximum pessimism, prices snap back in the opposite direction. And that's what makes the stock market so hard. We had to be prepared to sit through discomfort. It's just one of the unavoidable realities of the stock market. We've got to be prepared to sit through discomfort, follow a plan, and not give in to our emotions. The easy thing to do, I think the easy thing to do was to sell everything in probably in early to mid-May when prices start breaking down below the 100-day moving average. And there's lots of commentary about bad things were going to happen. I'm sure many people did. I'm sure many people did exit the market during March, and this probably made them feel comfortable with that position, particularly when prices were on their knees in late March. But unless they got back in within a couple of days of the low, which of course most people just don't do because they're always looking for things to get even worse, prices are now above where many people would have sold. And worse still, people who were piling into those bearish ETFs as prices were coming off, well, they've probably lost even more money. So no one's going to nail every twist and turn in these pullbacks, in the rebounds. It's just not going to happen. But I think the best overall outcomes, they really do go to those who have a good rules-based plan and then follow it. It's going to be hard, but in my experience, following the rules beat following emotions. So there's a round trip in the S&P 500 from all-time highs to lows that people thought the world was ending to back to all-time highs. So what do we make? What do we make of these new highs? Well, the first point is that prices have quickly gone from below those moving averages to above the averages. And this is important. It's something we often discuss. We just talked about it with the ASX 200 materials index. When prices get stretched, whether it be below or above, when prices get stretched from those moving averages, there's often they get stretched, and then there's a quick move from one side to the other when they quickly rally from below the averages to above. There's what follows next is what we call mean reversion. And mean reversion is just another way of saying that prices have run too far too fast and they need to pause and they need to pull back. And we often see that after these fast moves from below to above the averages or vice versa. We saw an example of this last May, just looking at the price action from last May when prices, they were stretched below the moving averages. They quickly recoiled to above, and then we had this pause for a couple of weeks. It was a short pause. It was a shallow consolidation, which showed the buying interest was there, and then things took off from that. And there's another example, just quickly, just back in July to September 2024, from below the moving averages to above, and then the pullback, the consolidation back to the moving averages, and then away from there. What happens here? Well, time will tell. It might do something different, but that's often a pattern that we see. And this is important. If we do get a pullback in the near term, what does it look like? Now that's the key part to the whole thing, I think. Is it a shallow pullback? Is it shallow where prices hold on to most of their gains, maybe stay above those moving averages? In that scenario, prices would then become established above the moving averages. So, for instance, if we got the price action like such, where you get a shallow pullback, holds the moving averages turn higher, well then that sets the platform for maybe another run at new all-time highs. That would be the I think probably one of the most positive scenarios. Or does selling come in and then start to drive prices low and we're quickly back down below the moving averages? That's when we start looking at, is a big range forming, are lower levels even coming? But it's like looking at that initial price action. Do the gains hold, or are they quickly sold? Just on the selling side, we go back to 2022. This is a couple of examples where we had quick rallies from below the averages to above, and they were quickly sold into. Here's another one from below to above, quickly sold into. So we don't know what we're going to get this time around. That's what I'm watching for, though. And I'll tell you what I've done in a moment. But first, I just want to give you a reason for some caution around this rally. It's one of the things that does worry me a touch about this rally in the S&P 500 and the new all-time highs, in that the new all-time highs have not been in conjunction with lots of new highs in individual stocks. So take Wednesday, for instance, just yesterday, when prices made their first new all-time high from this rally. On Wednesday, there are only 12 S&P 500 stocks that were at one-year highs. So the market making an all-time high, yet only 12 stocks are at one-year highs. So that's a question mark around the internal health of the market. It's only a question mark. It's not a bearish signal or anything, but it's one thing to keep in mind. And then we look at the percentage of stocks, percentage of S&P 500 stocks above their 100-day moving average, an indicator which we sometimes look at. And looking at where it is now, it's sitting at 52. So that's telling us 52% of S&P 500 stocks are currently above their 100-day moving averages. So that's unusual. A market at all-time high would generally have more stocks in uptrends. So again, that's a question mark around market participation. The optimistic view of this would be that the indicator is rebounding from low levels, and there's plenty of upside room for greater participation as the market moves higher. And that may be the case, but I think we have a couple of cautionary factors, at least for the moment, just to keep in mind. Again, that doesn't mean be bearish, but it's worth. I think it's both a reminder and a reason to manage risk. Nothing is all in. Nothing is green light go. We're always managing risk. There's always another side to consider. Now, coming over to the Nasdaq. Now, one of the great recoveries here in the Nasdaq, it's up about 15% in just 12 trading days, from the low to where we were on Thursday's close. That's 12 trading days. And it's an example of what can happen when sentiment is extreme and things go from bad to less bad. Things were particularly bad 2.5 weeks ago. I wouldn't say conditions are amazing at the moment. Straits still closed, oil's still not flowing, but things have gone to less bad, and that can cause these strong reactive rebounds in markets. Another interesting feature is that prices are up 12 days in a row. Now, that's a truly rare event for the Nasdaq. We've got 12 up days in a row, but it's only happened 8 times in the last 40 years. So now you might be wondering what happened the other 7 times that we had these 12 up days or more in a row. And what's interesting is that over the next year, the Nasdaq was higher every time. So every time the Nasdaq had 12 up days in a row, the next year it was up on that every time. But there were often pullbacks along the way, and some of them were notable pullbacks. For instance, 3 months later, stocks were down 7% on 2 previous occasions. So I think the potential volatility should never be overlooked, no matter how successful an indicator appears to be. So 12 up days in a row has been a successful indicator over the last 40 years, but 12 up days in a row, whilst it's significant, it doesn't guarantee what's going to happen going forward. I think it does indicate is that it indicates persistent buying, and persistent buying is a good indication of underlying strength. I think this is more about short. I think this is more. I think this is more than short covering. This rally we've had. I think it's repositioning back into stocks. Now, what I've just done, I bought a Nasdaq position on Friday afternoon last week after the strategy session. I used an ASX listed ETF. The ticker code is HNDQ. I'll just quickly show you. So this is a ASX listed. It's a beta shares, Nasdaq 100 ETF. And you'll notice that it's currency hedged. And I'll come back to that in a moment. There's Thursday that we did the show on Friday, and I bought as it looked like it was bouncing off the low. We had Friday's session. I went back, looked at the charts before the close, and thought, look, I need to reestablish a position. So I've done that. So you'll notice it's currency hedged, and that's to protect against a potential rise in the Aussie dollar. Now, the Aussie dollar, I'll show you what the Aussie's doing. Let me just change this. It's the US dollar. I'm going to come back to that in the members section in a moment. But looking at the Aussie dollar, so it's trading up at. Let me compress that a bit more. We're up at about 4-year highs in the Aussie. It hasn't been up here since mid 2022, and it's also above. See the rising moving averages. Prices above the moving averages. And so I think the path of least resistance for the Aussie is currently to the upside. So the declining Aussie dollar, Aussie had been in a downward trend for several years. That was a tailwind for international exposure. Now it looks like maybe that trend is reversing. Maybe we're going through a period where the Aussie dollar may be strong or may maintain quite well, may continue to trend higher against the US dollar. That becomes a headwind for international exposure. So that's why I've opted for a hedged ETF for this Nasdaq position. So just coming back over to the S&P 500 for a moment. As I said last week, I think there's enough here to start considering upside possibilities. And as always, I'll manage risk with an exit strategy. If a position isn't working, well, I'll move to protect capital. Yeah, this isn't about having strong views and needing to be right. A lot of fuss is made about high conviction and all this sort of thing. It's not so much about having a strong view where I'm rigid and that's the way it is. It's rather, for me, it's about flexible thinking, going with the price action. At the moment, the price action is giving us indications that we want to be positioned on the upside, not continuing to sit on the sideline waiting for a crash, as I understand many are doing from some of the commentaries that I see. Okay, so I'm going to jump to the small caps next. We've got the US, the Aussie small caps, we've got the commodities, you've got your stock code, so heaps more to go through. That wraps up the free section, though. If you're not a strategy session member, there's a link below. Come on in, doesn't cost very much, and we talk about all sorts of interesting things, and also go through stock codes you might be interested in if you just put them in the online chat as we go through live. All right, so coming over to the let's go to the Russell.